Module Overview. This module focuses on fiscal federalism, an essential component of federal governance that deals with financial relations and resource allocation across different tiers of government, federal, state, and local. In a federal system, the assignment of revenue-raising powers and expenditure responsibilities is often complex, and it requires a robust and equitable system to ensure effective service delivery, fiscal stability, and national cohesion. This module investigates the theoretical foundations, legal instruments, institutional frameworks, and operational realities of fiscal federalism, emphasizing how resources are raised, shared, and utilized. The discourse involves horizontal and vertical fiscal relations, revenue derivation principles, revenue sharing formulas, and the impact of intergovernmental transfers on autonomy and development. The module also assesses the political economy of fiscal decentralization, the tensions between centralized control and subnational autonomy, and the challenges of corruption, mismanagement, and inequity in resource distribution, especially in multi-ethnic federations like Nigeria, India, Brazil, and Ethiopia. Conceptual and theoretical foundations of fiscal federalism. Fiscal federalism refers to the financial interactions and arrangements among different levels of government in a federal system. Key principles: efficiency in public service delivery, equity in distribution of resources, accountability in expenditure, macroeconomic stability and sustainability. Foundational thinkers: Wallace E. Oates, Richard Musgrave, and James Buchanan. Functions of fiscal federalism: assigning expenditure responsibilities, e.g., education, healthcare, defense. Allocating taxing powers, e.g., income tax, VAT, customs duties. Managing intergovernmental transfers, e.g., grants, equalization payments. Promoting fiscal discipline and economic stability. Addressing regional disparities and development inequalities. Revenue generation and tax jurisdiction. Different levels of government are responsible for collecting specific taxes. Federal government, customs duties, VAT, value-added tax, company income tax, petroleum profit tax. State governments, personal income tax, pay, road taxes, land use charges. Local governments, tenement rates, market levies, motor park fees, tax assignment challenges, overlapping jurisdictions, tax evasion, and poor collection mechanisms, interference by higher levels of government. Revenue, allocation principles and formulas. Revenue allocation must balance equity, efficiency, and political realities. Major principles include derivation principle. Regions receive a portion of the revenue generated from their own resources, e.g., oil revenue in Nigeria's Niger Delta. Equality principle promotes even development by giving each region equal per capita or basic funding. Population principle. Allocations are weighted by population size. Need principle focuses on specific development needs, such as infrastructure or health indicators. Fiscal efficiency principle rewards regions that manage their resources better or grow their internal revenue base. Vertical and horizontal fiscal imbalances. Vertical imbalance occurs when lower tiers, state or local, have more spending responsibilities but limited revenue sources. Horizontal imbalance happens when some states or local governments are financially stronger than others, creating regional disparities. Mechanisms like equalization transfers, revenue sharing formulas, and conditional grants are used to address these imbalances. Intergovernmental fiscal transfers and conditionalities. Statutory transfers. Fixed by law, e.g., 13% derivation for oil-producing states in Nigeria. Discretionary transfers, given based on needs or political considerations, conditional grants, tied to specific programs, e.g., universal basic education, healthcare programs, matching grants. require subnational contributions to access federal funds. Fiscal autonomy versus fiscal centralization. Fiscal autonomy allows states and local governments to determine their budget priorities and funding mechanisms. Fiscal centralization can lead to overdependence on federal allocations, reducing innovation and accountability. Tensions often arise when local governments rely on state funds. States lack independence to fund their mandates. Central governments withhold allocations for political reasons. Institutional frameworks and legal provisions. Nigeria. Revenue mobilization. Allocation and Fiscal Commission, RMAFC, oversees revenue sharing. Constitutional backing for derivation and federation account. Section 162 of the 1999 Constitution. India. Finance commissions determine tax devolution and grant and aid United States. Block grants and categorical grants as intergovernmental funding tools. Challenges of fiscal federalism in practice. Political interference in allocations. Non-transparent budgeting systems, poor internal revenue generation capacity. Delayed or misapplied disbursement of funds, corruption, elite capture, and patronage politics. Global case studies and lessons. Brazil. Strong municipal autonomy, constitutionally guaranteed transfers. India. Constitutionally independent local bodies, but limited financial strength. Germany. Balanced fiscal coordination through the Stability Council. Nigeria. Over centralization of oil revenue. Conflict over derivation and sharing formulas. Learning outcomes. At the end of this module, you will understand the meaning, goals, and components of fiscal federalism. Identify the legal and institutional mechanisms for resource allocation. Analyze the dynamics of vertical and horizontal fiscal imbalances. Evaluate the effectiveness of revenue sharing principles and formulas. Propose reforms for transparent, accountable, and equitable resource distribution.